Top Trader Course. Trade Management. In this video, we'll be discussing the concept of trade management. Trade management is the rules one lays down for trade implemented in real time. In other words, you must know beforehand exactly how to respond to every possible scenario and never get caught off guard without a predefined response. In order to minimize and control the exposure of investment to risks, fund managers and investors practice risk management and trade management. While the former term deals with what one should invest in and how to diversify one's investments, the latter deals with what to do once in a position. Not giving due importance to risk management while making investment decisions might wreak havoc on investment in times of financial turmoil in an economy. Different levels of risk come attached with different categories of asset classes. Even when one buys low-risk government bonds over more risky corporate bonds, or when a fund manager hedges his currency exposure with currency derivatives, it should never be forgotten that nothing is certain in the markets and anything can happen. Stockbrokers use financial instruments like options and futures, and money managers use strategies like portfolios and investment diversification in order to mitigate or effectively manage risk. All this is part of the trading strategy. Every battle is won before it is fought. This phrase implies that planning and strategy, not the battles, win wars. Similarly, successful traders commonly quote the phrase, "plan the trade and trade the plan." Just like in a war, planning ahead can often mean the difference between success and failure. This cannot be emphasized enough. Stop loss and take profit points represent two key ways in which traders can plan ahead when trading. Successful traders know what price they are willing to pay and at what price they are willing to sell, and they measure the resulting returns against the probability of the asset hitting their goals. If the adjusted return is high enough, then they execute the trade. Conversely, unsuccessful traders often enter a trade without having any idea of the points at which they will sell at a profit or a loss. Like gamblers on a lucky or unlucky streak, emotions begin to take over and dictate their trades. Losses often provoke people to hold and hope to make their money back, while profits often entice traders to imprudently hold on for even more gains. A stop-loss point is the price at which a trader will sell a stock and take a loss on the trade. Often, this happens when a trade does not pan out in the way a trader hoped. The points are designed to prevent the "it will come back" mentality and limit losses before they escalate. For example, if a stock breaks below a key support level, traders often sell as soon as possible. On the other side of the table, a take profit point is the price at which a trader will sell a stock and take a profit on the trade. Often, this is when additional upside is limited given the risk. For example, if a stock is approaching a key resistance level after a large move upward, traders may want to sell before a period of consolidation takes place. Setting stop loss and take profit points is often done using technical analysis, but fundamental analysis can also play a key role in timing. For example, if a trader is holding a stock ahead of earnings as excitement builds, he or she may want to sell before the news hits the market if expectations have become too high, regardless of whether the take profit price has been hit. Moving averages represent the most popular way to set these points, as they are easy to calculate and widely tracked by the market. Key moving averages include the 5, 9, 20, 50, 100, and 200-day averages. These are best set by applying them to an asset chart and determining whether the asset's price has reacted to them in the past as either a support or resistance level. Another great way to place stop loss or take profit levels is on support or resistance trend lines. These can be drawn by connecting previous highs or lows that occurred on significant above average volume. Like with moving averages, the key is determining levels at which the price reacts to the trend lines and, of course, on high volume. When setting these points, here are some key considerations. Use longer-term moving averages for more volatile assets to reduce the chance that a meaningless price swing will trigger a stop-loss order to be executed. Adjust the moving averages to match target price ranges. For example, longer targets should use larger moving averages to reduce the number of signals generated. Stop losses should not be closer than 1.5 times the current high to low range or volatility, as it is too likely to get executed without reason. Adjust the stop loss according to the market's volatility. If the stock price isn't moving too much, then the stop loss points can be tightened. Use known fundamental events, such as earnings releases, interest rate decisions, and the non-farms payrolls, as the key time periods to be in or out of a trade as volatility and uncertainty can rise. Setting stop loss and take profit points is also necessary to calculate expected return. The importance of this calculation cannot be overstated, as it forces traders to think through their trades and rationalize them. As well, it gives them a systematic way to compare various trades and select only the most profitable ones. All this is but an example of a policy one may implement once entering a trade. There are many strategies, but the most important of them is to stick to your strategy. You want to be a cold-hearted, emotionless execution robot when in a trade.